Determining market composure has been challenging since an identifiable trend has not set in yet. One thing for sure is volatility is here to stay. Not only have we seen major swings across multiple asset classes and a slew of headlines out of the central banks, keep in mind Q2 and the first half are a few days from closing out and earnings season is right around the corner. Joining me from the floor of the CME is Mark Sebastian, COO of Option Pit and featured contributor on Options Profits. Mark, your work has been spot on, particularly the call out of VIX 20 on June 11th. Jim Cramer's also showcased your work for CNBC's Mad Money because the next move is more about fundamentals. Explain that to us and how you are looking to tactically position.
Yeah, well, it's really interesting. We've been watching the market kind of sit here and then the VIX rally all through May. Then finally we get this kind of market breakout where it sells off and the VIX kind of takes off. Now, a lot of people attributed much of the final 100 points of the S&P 500 to QE. Now that QE is starting to go away and we've seen the 10-year note really take a dive, although it's finally stabilizing today, then if we're going to have a leg up, this earnings season is really what's going to matter. Those fundamentals, we're going to need something else besides Fed policy to push us higher. So if the July earnings season is good, you could see that next leg up back to 1650, 1670, maybe even 1700.
Well, do you think there's been too much credence placed on the 10-year and the bonds as an asset class overall? Does it really matter that much, or is that just another excuse, kind of like QE has been?
Well, you know, I think there's one thing you have to watch is that there's a cascading effect in the bonds. It's a much bigger market than the equity market. And that 2.5 level was a major level for a lot of companies holding mortgage backs, you know, asset backed, you name it. So what we really were worried about there for a second was what's called a mechanical sell-off. Mechanical sell-off is created when traders are forced to sell winners to pay for losers. And if the 10-year really started to move a lot more, we could have ended into some sort of mechanical sell-off, and that's probably what could have cratered us down to that 15.25, 15.5 level. If the 10-year stabilizes, it's going to allow the market to start acting like it should, acting in a logical manner, if you will.
And finally, we've seen a lot of portfolio managers, traders, investors. They did so well the first 5 months of the year that they're in a big cash position right now and looking to see how June and the beginning of July is going to play out. We also have a lot of investors asking us how to hedge. I know we typically stay away from the ETNs, but what would you do using either the VIX, the SPX, even a currency type of hedge on your overall portfolio?
Yeah, you know, it's really easy to be a great asset manager when the market's up 17%, but you know, the S&Ps give away 100 points and all of a sudden the winners really do separate themselves from the losers. Mm-hmm. If you're looking to hedge, I would still be staying away from VXX, UVXY, all those ridiculous ETNs. Mm-hmm. Now, if we see something along the lines of futures backwardating, where front month futures are higher than back month, then you maybe enter those. But if you're looking to hedge, the cleanest way for retail traders to get in is still collaring using SPY or S&P 500. Leave VIX and VXX and some of those products to the more professional traders, the larger groups, because getting into VIX options can be an excellent way to hedge, but you really have to have a strong understanding of how the product works. So the cleanest way to do it for the retail trader is to collar, which was a great method leading into this sell-off and is a great method coming out of this sell-off.
Okay, great. Thank you, Mark. For more of Mark's strategy, check him out on optionpit.com and, of course, on optionsprofits.com.
For more of Jill Malandrino's plays for trading spikes in market activity, visit optionsprofits.com.